Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Let's start with today's big deals. A group of 12 states have sued Paramount on Monday, seeking to block its $110 billion bid to buy Warner Brothers Discovery. The states allege that the blockbuster Hollywood deal would leave viewers with higher prices and fewer choices for movies and television. Bloomberg's Michelle Davis has been following that story for us, and she joins us now. Michelle, it feels like a trend. States pushing back. What does it mean specifically for Paramount?
Exactly. There's a lot at stake here for Paramount. They have agreed to pay a ticking fee of $650 million for every quarter that their deal doesn't close after September 30th. And so that means if these states succeed in getting a judge to pause the Warner Brothers Paramount close, it's going to get expensive really fast for Warner Brothers, or for Paramount. The other thing is it is part of a broader trend where the states are really being emboldened and they're getting aggressive in trying to pursue and police antitrust enforcement on their own. There's a feeling, especially among Democrat state AGs, that the Trump administration and especially the FTC and the DOJ are kind of abdicating their responsibility. They're not pursuing antitrust enforcement the way they should, and so the states are trying to do it themselves. And they've had some victories already. They succeeded in getting Nexstar and Tegna to pause integration of their deal, even though regulators had already approved that deal. They also succeeded in getting a jury to rule that Live Nation is an anti-monopoly entity. So there's a lot of unknowns here, but it really seems like the states have big clause.
Well, to the point of federal regulation being more loose, the FCC is set to repeal the audience cap. And I wonder what exactly that means, because it's being framed as sort of a win for some of the deal makers attempting to push that through, specifically Nexstar.
Yeah, so one read-through from that is if you do get rid of this 39% cap on reaching broadcast audiences, that could pave the way for other broadcasters beyond Nexstar and Tegna to pursue their own M&A. There are others out there, including Sinclair, Scripps, that haven't done M&A yet. This could make it easier for them to do that. But at the end of the day, the FCC already suspended this 39% cap when they cleared the Nexstar-Tegna deal. Nexstar-Tegna together control 80% of U.S. households. What this means is courts are really going to be the ones to determine whether it can be lifted. There's scrutiny or disagreement about whether it's Congress or the FCC that can actually make this decision. There's a court case next year that will decide whether Nexstar and Tegna can actually close this deal. And so this development just means that it could be a little harder for them to keep the deal from closing. All
right, Michelle, thank you very much for your reporting the latest on media deals. Elsewhere in the world of tech, sources telling Bloomberg that payment processing company Stripe and PE firm Advent have offered to buy PayPal for more than $50 billion. Bloomberg's Ryan Gold has been following the story, joins us now. And Ryan, I know you were reporting back in February that Stripe had been basically poking around with PayPal. What difference does it make to now have potentially Advent part of this deal?
I think it gives, on the one hand, a lot of credibility to Stripe. I think off the bat, you would say any deal maker, you speak to a banker, to a lawyer, that any private company looking to go out and buy a $50 billion plus public company is going to have a pretty tough time of it. So I think on the one hand, you could say that Advent really gives some credibility towards Stripe's interest and bid. But I also think on the other side of it, I think it really gets at something maybe we were just talking about on the antitrust front, which is that I was on Carol and Tim's Business Week radio show on Monday, basically making the claim that we're now in the midst of a really, really significant Trump-induced deals boom. I mean, you wouldn't really have seen this type of deal be contemplated, I would say, at least 2 years ago, 3 years ago under Joe Biden. And this is going to be a very long road for these two companies as this goes ahead. I mean, this is a $50 billion plus company where you've got ostensibly its biggest competitor, though it's private, looking to acquire it. With or without a private equity firm, I just think that that's going to give be a tough time for regulators.
Well, then you have kind of the same thing happening cross-border with giants who have a lot of market share looking to merge, specifically Uber, the team reporting that they're in advanced talks to take over Germany's delivery hero. What do we know about that?
Yeah, so Uber is about to make its biggest deal in quite a number of years. By all accounts, we reported yesterday that they're in advanced talks. Delivery Hero confirmed it. Uber's looking to pay around 40 euros a share, which is quite a bit higher than where the shares have been trading in recent weeks. That's also a deal that is going to come, could come unstuck from an antitrust perspective. Delivery Hero operates in around 60 markets across Europe and the Middle East. Uber, as we well know, is pretty global itself. And if you look at deals like Just Eat Takeaway with Process, if you look at deals with like DoorDash Deliveroo in the UK, even something like DoorDash Wolt in Germany, this is already a very, very fragmented market. And so we kind of get into an equation where you could potentially be looking at 5 to 4, 4 to 3. These are kind of going to really challenge the core basis of antitrust law.
All right, Ryan, thank you very much. That's Bloomberg's Ryan Gould. Staying in the world of tech, Anthropic seeking to meet with investors ahead of its potential mega IPO, according to people familiar. That joins a rush of AI-driven stock market debuts. Bloomberg Tech Ed Ludlow joins us now for more. OpenAI pulls back. It seems like Anthropic full steam ahead, Ed.
Yeah, it's literally full steam ahead. So this is what we call testing the waters meetings, right? Where the bankers say, this is who you want to speak to, kind of sound out early indications of how you would structure price, valuation, etc. I just got back from New York with you last week, right? And when I was in town, there was nothing that would indicate that anything had changed for Anthropic. That they are looking at, based on our reporting, October, the fall, to do this listing, and they haven't really deviated from that. And internally, as much as they are speaking with all of the stakeholders outside of the building, they're also doing all the preparations that they would need to make to pull off a listing of that side. And like as a reminder, their last private market valuation was $965 billion post-money. So it's no small feat, but I think you're exactly right that you just say this is kind of moving forward full steam ahead.
So, okay, we're going to get Anthropic. There's also been reporting that it seems DeepSeek will come to market. Ed, I wonder if this would spook any of the would-be IPOers, that we now have SpaceX trading at $133 per share, which is now for the first time below its IPO price.
This is Bloomberg Deals. Somebody put the alert banner up, the breaking news banner, that SpaceX is below $135 a share. I mean, look, what's changed materially in the last 7 days on the SpaceX side is like all of the banks that were a party to the deal on the sell side initiated coverage. And of course, they're all super bullish. You're trading at 133.24. A lot of SpaceX's future is predicated in the future, right? I would say, like, this is the deal show, but it's why Bloomberg will carry the Starship test tomorrow. There are very few short-term catalysts to look at with SpaceX. It's all so far into the distant future. It's all science fiction until it's real. So how the stock trades is interesting. I would frame it slightly differently. Like with Anthropic, the reporting on OpenAI kicking an IPO into 2027, what I understand is that the executives of both companies read the SpaceX prospectus very closely and sort of looked at how SpaceX presented itself as an AI company in that IPO, in partly informing their own decision, right? A lot of the bankers on these deals are in common, different teams separated by walls. But the trading in the short term, does that shut the IPO window? Don't know. Don't think so.
Ed, thank you so much for your continued coverage of this. That's Bloomberg Tech's Ed Ludlow. By the way, fortunes minted in some of the U.S. tech industry are on both sides of a record-breaking deal for the Seattle Seahawks. Scarlet Fu is covering that story for us. Scarlet?
That's right. The Seattle Seahawks is changing hands in a deal worth $9.6 billion. That is the most ever for an NFL team, and it tops the previous high of $6 billion paid by Josh Harris for the Washington Commanders in 2023. And as you mentioned, Danny, tech is on both sides of the deal. The estate of Microsoft co-founder Paul Allen, who died back in 2018, entering a formal agreement to sell the Seahawks to a group led by the family of Vinod Khosla. He's a giant in the VC world. Khosla co-founded Sun Microsystems in 1983 before moving on to the investing side. He is an early investor in OpenAI. Terms of the Seahawks transaction have not been disclosed, and it's not clear which other buyers may join Khosla. Also, the NFL still needs to approve this sale as well. But what we do know is that Khosla's group beat out Indian steel tycoon Aditya Mittal alongside former Boston Celtics owner Wyc Grousbeck. So we'll keep you posted on further developments.
Scarlett, thank you so much for that. Now, for deal making in general, 2026 has already been a blockbuster year, and that's even with a backup of private equity deals. Goldman Sachs CEO David Solomon says that sponsor activity is still trading below its 10-year average.
A lot of the dialogues I'm having with CEOs are dreaming and thinking about, really large, structurally scale-enhancing opportunities, and that's leading to, just a lot more strategic activity. Sponsor stuff still has not accelerated, and candidly, it's going to come at some point.
David Solomon there, the CEO of Goldman Sachs, again saying that the pipeline is robust, but still we haven't seen that activity quite yet pick up from private equity. Joining now is a veteran of the space. It's Collin Roche, co-CEO of GTCR, a PE firm with investments across financial services, tech, healthcare, media, and telecom. And he joins me now to take a look at the big picture. Collin, so great to see you. Thanks for joining.
Thanks for having me, Danny.
And look, I mean, David Solomon has a point. I know you've made some sizable exits and you've been active, so let's put GTCR for the side for the moment. But overall, we're still looking at quite a backlog of companies. PitchBook had it something like over 13,000 companies still sitting among private equity. What basically unclogs this thing?
Yeah, I don't know. Our industry had a lot of inflows of capital that drove prices up. The risk tolerance went way up, incommensurate with the return, and that kind of peaked in 21. And now we've been living with the fallout from that. And we're in long duration assets, so it doesn't get reconciled very quickly. I think everybody is surprised how deal volumes haven't picked up. LPs are committing less, and many sponsors are afraid of committing because they don't know if they can raise their next fund. And how that gets unclogged, I mean, it has to eventually. Right. But it hasn't happened, and now you've got the AI overhang, which is another factor in terms of whether, if you're a sponsor and you've got a company, are you going to get a bid? Is the AI overhang on that company going to mean you don't have a bidder? So we'll see how it plays out. The financing is there. There's a lot of opportunity on the financing side, and that's pretty healthy, notwithstanding what's happened in private credit. But it's really, is the bid there, especially for larger assets. If you're talking the middle market, that's much more active. But the larger deals, it's a little more dicey whether there's a bid.
But there's been this real trend of creative liquidity solutions, be it continuation vehicles, more evergreen funds, what have you. So is that pressure really there to start selling? You said it needs to happen at some point. As long as you have these solutions, what finally creates the pressure to open up the dams?
Yeah, I mean, it's the continuation vehicle market where you find some new investors to buy that asset, that company from an existing fund. That has become a fairly big part of private equity liquidity. There are estimates anywhere from 15 to 25% of liquidity. But those are your better companies. So what the issue isn't those businesses can get sold. It's the company that's gone sideways, that maybe you overpaid for, maybe it was over leveraged and hasn't performed, and then rates went up, and then you had negative free cash flow where you haven't compounded value. And maybe for many sponsors, you're carrying it at too high a multiple because of that. And you can't sell it at a premium to that carrying value. You can sell it only at a discount, which obviously looks bad. That's really that great number of companies you're referring to that aren't getting transacted upon.
So have you found your way around this? I was just looking at some of your recent exits. WorldPay, Assured Partners. How are you not facing that same pressure? Is it just you didn't buy these at expensive valuations, basically?
Yeah, I mean, it's sticking to your knitting. It's understanding when things get frothy like they did in late 20 and 21 and the very first part of 22, that's a better time to be a buyer or a seller than a buyer. It's also being very disciplined on your marks, how you carry it. And that's a discipline on the investment teams. They need to see that, gee, maybe you paid 18 times for a business, but that business is worth 14 times today. If you carry it there, you're more realistic, but you can also then sell it. Now, the key part of that is, if you're going to have that kind of multiple compression, did you create value that offsets that, right? So that's another thing. Our industry kind of became leveraged beta and lost track of, we need to be in the value creation business. Right. We're not in the buying and selling business.
Well, a lot of ways that we've seen a lot of your peers talk about creating value now is like, we're teaming up with X AI LLM and they're going to come in and they're going to make differences. I wonder, does that actually add a source of alpha to try to AIify or whatever the word might be for your companies?
I mean, we'll see. Our view at GTCR is that needs to be internal to the private equity firm, and that needs to be internal to the management team of the portfolio company. Our model, working closely with our management teams, we affect change in every investment. We call it transformation, and AI is now a huge part of that. But we think the private equity firm of the future needs to have that as the core part of their DNA. We have most of our firms on co-work on Anthropic. We have been early adopters to these AI technologies. They're amazing. We're still trying to figure out how to deploy them into portfolio companies, especially to find costs and efficiencies. But the power of these tools is there. And private equity firms need to own that intellectual capital to deploy it in their portfolio.
Collin, the other thing that's been happening in your industry is calls, and not just calls, but action of consolidation. I mean, you're a large platform, you're $50 billion, but this thought has arisen, you can't be tens of billions. You have to be hundreds of billions. I wonder if you agree with that, and if you yourself would even look at M&A to grow the size of your firm.
It's not a priority for us. What I'd say is, you talked about the Advent deal earlier. Great firm. There's some other great firms that we compete with. We're by and large monoline firms. We primarily do control private equity, and we try to do it really well and have alpha in what we do. There's some other forms of private equity that are much more index-based, and that's fine if you want to get exposure to a private equity index. But the real outperformers tend to be monoline, and that's okay. So that's where we're positioned, and many of our peers are oriented the same.
I just wonder, do you see large, and only a little bit of time here left, Collin, but like large consolidation for those who aren't monoline and maybe aren't one of the big platforms?
Yeah, I think you're going to see more of that because, you've got some weak hands out there that have some capability, but maybe should be part of some other platform that needs that capability.
All right, Collin, this has been way too short. I hope you'll come back and join. I blame Kevin Warsh for what it's worth. Collin Roche of GTCR. Coming up, major banks post record profits, driven in no small part thanks to M&A. That's up next. This is Bloomberg. Welcome back to Bloomberg Deals. I'm Danny Berger. Some big deals and even bigger IPOs helped boost revenue and profit at the largest banks last quarter. Scarlet is taking a closer look at what we've learned from their earnings this week. Scar.
Danny, the M&A boom and the mammoth SpaceX IPO were very lucrative for Wall Street deal makers. This week's release of earnings show investment banking fees at the 6 biggest banks surged by double digits in the first half of 2026. Goldman Sachs is the perennial #1 in the league table, and we saw the firm lead the way with $6.25 billion in IB fees. That's up 52% over last year. Morgan Stanley had the second biggest gain with a 47% jump. JP Morgan and Bank of America then followed with at least 30% gains, followed by Citi and Wells Fargo with at least 18% gains. Goldman's CEO David Solomon sees no slowdown either, with the firm's backlog at a 5-year high and the second highest level on record. So the question is, what is driving all this activity? It's AI. The new technology is prompting companies to focus on achieving scale, which leads to their seeking more strategic opportunities. Here's what Wells Fargo's CFO told Bloomberg.
You're certainly seeing, across a number of different industries, sort of, deals that may not have been, totally possible, a couple of years ago. And the conversations the team's having, it really spans everything from healthcare to tech to media to, a whole different, all industrial sectors as well. And so I think you're seeing it in a pretty broad-based way. Now we'll have to see what actually happens in terms of deals getting announced and done, but I think the activity level is quite high.
Wells Fargo CFO there. And of course, Danny, there's also the permissive regulatory environment as well. Can't discount that.
Certainly cannot. Scarlet, thank you so much. And that brings us to this week's investment committee, where we take you into the boardroom debates in real time. Today's IC, we're going to be talking about deals within banks, within finance firms and financial services themselves. Our IC members today, Natalie Ings, partner and head of Portfolio Solutions at Lightyear Capital, a firm focused in financial services with more than $8 billion of AUM. Margaret Tahyar, she's partner and co-head of FIG at Davis Polk. She's also a member of the firm's Fintech team. And Elyse Reilly, she's a partner leading financial services for EY Parthenon. Thank you both so much for joining, all three of you. It's great to see you. Elyse, let me start with you, because I know you're constantly talking to clients about this. What would kind of be your pitch to the IC? What sort of areas, sectors, or types of deals do you think are most attractive in this environment for FIG?
Yeah, absolutely. Thank you so much for having me. And from our perspective, we're really looking forward to continued consolidation within the regional bank and wealth management space in the coming periods.
And how about you, Meg? What sort of activity, where are you seeing it concentrated?
So I think we're seeing, I agree, regional banks, the industrial logic for regional bank consolidation, particularly with AI and tech investment, they just need to have scale. And I think we before the regulators blocked it. Now the regulators aren't blocking it. The key challenge to getting deals done is that there are more buyers than sellers.
It's a really interesting point. Natalie, let me bring you in because you would be one of those buyers, obviously probably less concentrated on regional banks. But at Lightyear, where's the most ripe opportunity for buying different companies?
Yeah, at Lightyear, we deploy an asset-light strategy across 6 investment themes. We define financial services as investing at the nexus of financial services and technology, healthcare, and tech-enabled business services. So we're seeing a really rich opportunity set coming through investment committee across those areas and in our 6 investment themes. This year, we've already signed 4 deals, and those deals are in the areas of wealth management, a high net worth tax services business, a voluntary benefits business, and a municipal parking payments business.
Interesting. Okay, let's dig through some of these a little bit more deep. Elyse, when it comes to this idea of some of the regional banks, I wonder what they're buying them for and what aim. What are sort of the gaps that they're trying to fill? Is it, to Meg's point, something that helps them with AI or something different?
Absolutely. We're seeing clients really focus on buying for capabilities and scale. So when we are talking to our clients, they're looking at targets that are going to drive that growth agenda for them, particularly with management teams that are looking internally and evaluating themselves. They're taking a look at themselves and saying, what should I be divesting? And how can I use that to acquire capabilities that are going to drive my growth agenda?
So it's on both sides. It's not necessarily these banks are just active buying things. They're also actively looking at offloading different assets?
Absolutely. That's how they're driving their capital agenda.
I do wonder, though, if a lot of this is for scale, Meg, and you mentioned this with the regulatory environment, is basically everything on the table? I mean, we're talking today about maybe Stripe buying PayPal. Is the door wide open to any type of deal in any scale here in the U.S.?
And in the subsectors of the financial sector, because you're talking about payments, crypto, stable coin. There's just an enormous amount of ferment and innovation going on in the financial sector. So it's not just regional banks. I do think I would add to what Elyse said, that I think that on the regional bank side, what's also driving it is succession planning, talent planning, in addition to technology and AI.
And Natalie, are you seeing that on your side, some of the succession and talent planning being a large driver of why a company would want to come to you and partner with Lightyear?
Yeah, absolutely. About a third of our deals have come from other smaller sponsors, a third from founders, and a third actually are carve-outs. So the divestitures point that Elyse mentioned is also a really exciting opportunity for us. In fact, Pay by Phone, which was the municipal parking payments business, was a carve-out from Corpay, a publicly traded parent. So we're seeing a lot of opportunity. The succession planning is a really important point. And I think the other point that Elyse mentioned is in the wealth management area, there's a lot of consolidation that is also driven by succession planning, with advisors wanting to move into a larger business so they can avoid, all of the compliance issues and also create succession planning for their younger advisors and their clients.
Natalie, on the point of this PayPal deal, and you mentioned this too, you're seeing some public companies spin off different investments. I wonder what sort of seems to be the divide of where there are opportunities. Are there interesting things in take privates, for example, PayPal's of the world or their own assets, or are you seeing the bulk of opportunity happening already privately owned companies?
We're seeing a mix. I mean, I'd say our pipeline is probably slanted towards private transactions, but we certainly see opportunities in carve-outs from publicly traded parents. And so, as I said, a third of our investments over Lightyear's history, our 25-year history, have come from carve-outs. So we continue to see a rich opportunity set there.
Elyse, what are you seeing in terms of private versus public opportunities?
I think we're seeing a good mix, but what we're seeing, and we want to make sure that companies are clear on, is that while there is significant uncertainty right now, those companies that are holding back during that uncertainty historically have not been at the top of their game when it comes to comparing to competitors. So our encouragement is to push through that uncertainty and think about what M&A aspects are going to continue to drive your growth agenda.
So, okay, regional banks, some payment services, but we did hear from the big banks. Scarlet was just talking about it. In that, you had Morgan Stanley saying, we're really conservative. It's a really high bar for us to do any M&A. The quarter before, JP Morgan was like, we're actively hunting for deals. It feels like they always are. What are you expecting in terms of the big bank, the bulge brackets, and their ability and desire to do deals?
Yeah, from the bulge brackets, I think that we're really looking to see them acquire for capabilities that are going to drive their specific growth agenda rather than mega deals.
Okay. What are you seeing, Meg, in terms of are mega deals active, possible, or is it more sort of what Elyse is saying, less mega deals?
It's less mega deals and more specialty fill-ins, whether it's a line of business, whether it's a capability, whether it's technology. And if you look at the pattern of deals that have been done by the bulge brackets over the last several years, that's what you see.
What about cross-border deals? We saw some kind of to start the year with Santander coming in.
Right.
Do you expect any more of that?
Yes, I do think that there are foreign banks that are interested in re-entering the U.S. market.
How do you think regulators will treat that?
I think it's going to depend upon the foreign bank. I think we're going to look at each foreign bank and its regulatory history and its fundamentals.
So if we can just wrap things up, I'd quickly love to get a flavor of two things, valuations and deal volumes. Natalie, let me just start with you. In the companies that you look like, how are valuations looking? Are they frothy? Are they reasonable?
I think it's a mix. I think high quality companies are trading well and lower quality companies are either not trading or coming in at lower multiples, not clearing multiples, and so the businesses, that's why they're not trading. So we see a mix. I think we're very disciplined at Lightyear on price and very disciplined around what we look at and spend time on. So as I said, we've been able to transact on 4 companies this year so far, all really exciting businesses at valuations that our investment committee was comfortable with.
Elyse?
Yeah, absolutely. So when we're looking at the market over the historical period, while values have been down, volumes have been up. We're seeing that trend continue into the second half of 26 and beyond, and looking for companies that are continuing to move forward in the face of uncertainty. Those are the companies that are going to win.
Yeah, are you seeing something similar where valuations look reasonable depending on where you look?
I think just speaking just in the regional bank space,
Right.
I think the challenge is there are more buyers than sellers, and
Yes.
law of supply and demand leads to price mismatches in that kind of market.
Do you think that means, and again, quickly we'll wrap it up here with this, but that deal volume will remain somewhat muted for the rest of the year just because of that imbalance?
It's odd, right? We've been seeing a fair number of activity in the below the $10 billion asset mark, but not much above that. The answer is, you know, predicting the future is hard.
I'm going to ask you, Elyse, to also predict the future. What do you think in terms of volume from here?
We're anticipating that volume continues to grow. We're looking at pipeline and seeing a strong indicator in our pipeline.
All right, we're going to have to leave it there. Thank you three so much for joining. Really a pleasure to have you. That is today's investment committee, Natalie Ings with Lightyear Capital, Margaret Tahyar with Davis Polk, and Elyse Reilly with EY. Coming up next, despite volatility, venture capital has been flowing steadily into the AI sector. Carolina Brochado, head of EQT Ventures, tells us where she sees VC heading next. This is Bloomberg Deals. You're watching Bloomberg Deals. I'm Danny Berger. Time now for an alternative view. By the end of this year, 3 massive companies are expected to have gone public. SpaceX, Anthropic, maybe OpenAI. I guess we can add DeepSeek to that too. And that will bring a major influx of cash to VC, venture capitalists, that made early bets on those companies. So where does the capital flow next? We're joined now by Carolina Brochado. She's head of EQT Ventures and head of growth for the U.S. at EQT Partners. Carolina, thank you so much for joining.
Thank you for having me.
And look, I think this is a really interesting dynamic because for VC and growth where you operate, the same criticism has been made for all of private equity, that money has been tied up, we haven't seen returns, but these are about to be some big unlocks of capital.
Yes.
What does it do to the ecosystem to have these big IPOs coming to market?
Yes. At the end of the day, it's a virtuous circle, not only of talent, but of capital that comes back into the ecosystem. So we've seen this for a long time. And if you think about the PayPal mafia, they've come back, they've started new businesses, they've started venture capital funds, and we see that across the ecosystem over time. What we're seeing now, because of the AI paradigm shift, which we think is such a massive opportunity relative to the opportunities before, is that we think that a lot of this value is going to be in private capital for a long time.
Well, one of the things I thought was interesting about your all's relationship to SpaceX is you do have some space-based startups that you've backed. So Star Cloud, infrastructure for space data centers, exploration company, basically Europe's answer to SpaceX. Does having SpaceX out there being public help you or hurt you because maybe it's competing for some of the same capital? Did it change anything for you?
It absolutely helps. It helps bring attention to space and the space race as it is in this new iteration. So what we've seen is a lot of interest now in several of our businesses, as you mentioned, Star Cloud, which is trying to build data centers in space, and the Exploration Company, which is focused on reusable capsules, but also going into things like launching. And it really has also been at the same time as we've seen a big shift into reindustrialization and a lot of focus, some of it that's sovereignty based, and some of it that is just AI based as well.
By the way, you're going to have to come back so we can do like a whole hour about data centers in space.
Yes, perfect.
Because I love it and it's like very sci-fi and I can't wrap my head around it exactly. But with all of this, I mean, we have seen, for example, SpaceX today, it's trading below its IPO price. So it's good, it gets people interested, but what does that volatility do, especially as you think about exiting some of these companies?
Yes. When you invest early stage, you really have to have a very long-term mindset, right? Sometimes we invest in founders where it's just an idea, it's pre-product, and you know that they're going to be in some sort of valley for 4-5 years. And deep tech, it might be even longer, right? Because some of the milestones are technical based and then scientific based. And so if you invest in SpaceX, you have to be in it for the ride as a long-term investor.
So you have these space investments. You also have a healthy portfolio of more robotics and hardware companies.
Yes.
It's interesting to look at because traditionally when you think of VC and growth, you think of asset-light businesses. These certainly are not asset-light businesses. Is this a wholesale change in what's attractive and what makes sense to be investing in right now?
Yes. Our goal at EQT Ventures is to invest through the waves and through the cycles which happen, because if you're in ventures, you're really investing at the forefront and what's around the corner. And for the last 10 years, we have thought that deep tech has been around the corner. So now we're in quite a nice position with AI and the reindustrialization of everything. But it's absolutely true, particularly as you come into growth stage, that with software was really exciting because it was highly recurring, it was sticky, and it was asset light. And now what we're seeing is that many software businesses are actually trending into services or into hardware. As AI has really changed the playing field in many ways.
Well, one of those, maybe we could point to another investment of yours is Harvey, and I know specifically looking at Europe for that. Since you have such a good crystal ball, how have you been thinking about what these types of companies do to labor markets? Like, do you see something like a Harvey coming in and actually replacing jobs of lawyers and paralegals? And are you backing more companies that have the ability to do that?
Yes, if you take a step back, well, how we think about it is the software market was something like 1.2 trillion. We think that AI, if you think about it relative to the services industry, could be a 15 trillion opportunity. So we go out and we think about what are the pieces of the world where it makes sense for AI to increase productivity gains. Legal is a very obvious place for that. Customer service is a really obvious place for that, and we're invested in a business called Parloa. Lovable is a really great example of vibe coding, right? Which now anyone can be a developer. We think that ultimately this will create more jobs, this will make jobs more interesting, but of course in the short term there might be a change management of what do people do every day might shift.
Have you been vibe coding at all?
I do vibe code.
What have you vibe coded?
Well, most recently I helped my daughter and her girlfriends put online a bracelet making business.
I like it. Very entrepreneurial of them too. I see kind of a nice overlap between what you do there. So part of your role at EQT Ventures, I know you're highly involved in the Europe Scale-Up Fund, which EQT won the mandate for. How has that been going?
That's been such a terrific initiative, we think, because we see as a clear gap, as someone who's been operating in this market for many years, that there is a clear gap at growth stage, and particularly for deep tech businesses in Europe. So we think that this was a fantastic initiative. We're thrilled to have won it because, of course, we have ventures, we have growth, and we have a life sciences venture business. And so across all of the people we have, all the PhDs in life sciences and the technologists in ventures, we hope that we'll be able to drive a lot of investment.
Is there a timeline there of like when capital can start getting put to work?
Very, very imminently, we think.
Okay, well, you'll have to bring us any deals as they come.
We
Carolina,
will.
we're going to have to end it there. Thank you so much for joining.
Thank you.
Really appreciate your time, Carolina Brochado, head of EQT Ventures and head of growth for the U.S. at EQT Partners. Coming up, a new deal could have Apollo going to the bat for the Yankees, plus a PE deal that could also see a change of hands for one of the only makers of MLB baseballs. All of that to come. This is Bloomberg Deals. You're watching Bloomberg Deals. I'm Danny Berger alongside Scarlet Fu. Sports fans may be focusing on the World Cup, but Apollo has its eyes on the MLB. Sources telling Bloomberg that New York Yankees are in advanced talks to raise nearly $3 billion of financing from Apollo. Scarlet Fu and Bloomberg's Ryan Gould are back with me. Scarlet, this Yankees deal, I feel like there had been some rumor mills swirling around about the Yankees looking at selling stakes. This is interesting because it's not just debt, but it looks like a little bit of equity that they're giving up to Apollo.
That's what we're hearing. That's what the reporting is showing us, that the discussions, and they're deep discussions right now, are to raise as much as $3 billion. The terms of the package would be made up of debt and some equity as well. We don't know beyond that. Some of the proceeds, the money raised, will be used to refinance existing debt, and also the balance will be used to look for growth opportunities. And we know that the Yankees, the family that owns the Yankees, their holding company, they've already invested quite a bit in soccer. So we come full circle here, right? They own stakes in AC Milan and NYCFC in the MLS.
That's interesting. And I guess like PE going in, because it's something we've all discussed before, that the NFL has hard caps, how much they can own. Does the MLB have the same structure?
They do have some rules. PE firms are not allowed to become a majority owner of a single franchise, and a single fund is capped at a 15% stake overall. So,
and it's like everything in this ecosystem is hot, because Ryan, I know you were reporting on Rawlings, the company that makes a lot of baseball things, right? They make like
the
bats, the supplier,
gloves and balls, the match ball supplier,
baseball things, the technical, and a PE firm owns them. So what, they're looking at selling it?
So Seedler Equity Partners, which is a fairly small firm based out in sort of, I'll just say California. I don't want to get it correct here, but they are looking to sell their stake. They own the majority of Rawlings. I mean, it's a 139-year-old company. As I said, they're the match ball supplier to the MLB. They co-own it actually with the MLB, and so they're looking to cash out. I think at this point, it's still fairly early stages in the sale process, but I think it really gets at the heart of the fact that PE firms are looking to get into very high contact sort of sports and franchises.
Yeah, literally like anything, gear, teams. It feels like it doesn't matter.
Every level, right? From youth sports to the pros, it's going all the way out and around the sports ecosystem as well.
By the way, how much anxiety, Ryan, speaking of sports, are you feeling for 3 p.m. today, England?
I don't know. Argentina? I have anxiety about where I'm going to watch the game, let alone the game itself.
Oh boy, hopefully not at your desk. You got to get out somewhere and support the team. Thank you both so much, Ryan. As always, that's Ryan Gould and Scarlet Fu, always alongside me here for Bloomberg Deals. And that does it for the show today. Stay up to speed even after the show. Subscribe to the Bloomberg Deals newsletter. But first, up next, Bounce of Power live from Washington.